Hey everyone and welcome back. As you can see, today we are doing stock market Q&A for the first month of 2021, and I'm excited for another year where we're going to go through and do one of these every single month. Although, as I'm saying that, I realize that doing one Q&A video a month is not some grand achievement, but we are going to continue, as we did last year, doing one every single month. And of course, I've already collected all of the questions for this month's video. But if you're wondering how you can get a question in next month's video, it's very, very simple. The first thing you need to do is go right below this video and click subscribe, hit the notification bell, and that way you will be notified when I make the post on the YouTube community board when I ask for questions. So on my channel, there is a tab called the community tab, and it's where I can write posts to you guys. And once a month on there, I ask for questions. And if you want to be quick, which you need to be quick in order to get your questions in this video, then you need to have post notifications turned on, all notifications turned on when you're subscribed. So with that said, hope you guys enjoyed today's video. And as always, let's jump into it. The first question that we've got here comes from Tom. I'm interested in how you would go about calculating the debasement of the Australian dollar. That's devaluing, or the loss of purchasing power in the Australian dollar, for those who don't know. I can look at the RBA, Reserve Bank of Australia's balance sheet, and see that it has doubled since the beginning of 2020. But how much does this dilute the value of the Australian dollar, and where do I find this information? Cheers. Yeah, that's a really good question. The first thing I want to say is I really don't go about calculating what the reduction in purchasing power or the reduction in the value of the Australian dollar is going to be. I put it in the box of important but unknowable, right? Warren Buffett has these 4 boxes. Kind of on one side you have important or not important, and on the other side you have knowable and unknowable. I think that the devaluing of currency is something that is important, so it does have an impact on our returns depending on where we have our money, but it is something that is unknowable. There are just too many factors that go into figuring out what that rate is going to be. For example, what you just mentioned is one of the factors, the increase of the balance sheet. Interest rates is, of course, another factor. Technological advancement typically improves the purchasing power of the Australian dollar. Globalization that has occurred over the past couple of decades is also something that has improved the purchasing power of the dollar through the reduction of business expenses, shipping employees and other things offshore. But how those factors will interact, and the many other factors that are involved, how those will interact in the future is not something that I think is predictable, and as a result, I don't try and predict it. The next question that we've got here comes from Lachlan. What are some of the companies on your watch list if they go to a margin of safety price? Yeah, that's a really good question, and I think the first thing to say is that I have more businesses that I think are really great businesses that are not at an appropriate price than I do in my portfolio. So most of the businesses that I've analyzed and think are a really great business, most of them are not at an appropriate price. And that's going to be expected. If it is a really great business, people recognize it most of the time. And really those businesses that are great are only investable to make a consistent high rate of return, 15+%, when they are going through some kind of short-term problem, which for some businesses will not happen. The stock's price will always be high, reflecting the really great value of that business. And for other businesses, they will go through a number of short-term problems that give you the opportunity to invest. Just to name a couple of them, I guess, I really like Costco as a business. I think it's probably one of the best managed companies on the US market, probably globally as well, but I think it's too expensive. I really like Visa and MasterCard, even though they do have higher debt than the typical ratios that I look at. Their business is just so sound, and they're in such a strange position where they really don't reinvest any money, yet they continue to compound their business and grow their cash flows at a ridiculous double-digit rate, which is a very, very unique business opportunity where both businesses combined have such a grasp on the payments industry. I think it's 90+% market share in that industry, that it is very, very difficult for anybody to compete against them. And as a result, they just capture all of the growth coming out of the industry. But as I mentioned, for these businesses to get cheap enough, something significant would have to happen to their business, right? For Visa and MasterCard, I think their stock prices would probably need to go down probably 50%, maybe even more than 50%. I honestly haven't looked at their valuations recently, so I can't really remember. And I haven't looked at their stock prices either because they've been so consistently high. But there may very well be something that people don't foresee that impacts their business in the short term and may provide a buying opportunity, or maybe not. And that's okay. For some businesses, I want to invest in them, but I never will because they never get cheap enough. But there will be businesses on my watch list that do, and I'll invest in those. And it doesn't really matter if you miss out on investing in a business because it never got cheap enough and it continues to go up. What matters is the businesses that you do pick, that they are good investments. So, and you really don't need to make a lot of them. You make 5 to 10 of those, 10 to 15 of those over your lifetime, and you will do very, very well. The next question that we've got here comes from Jack. Hey Hamish, this question is a follow-on from your video where you said you waited 2 years to invest in a business which led to a huge gain rather than a big loss. For those who are not aware, that video was about a company called Corporate Travel Management, which I first spoke about on the channel 2 years ago, but I didn't invest in them until March of 2020, not this year, March of 2020. And the difference was a significant return that I've generated on that stock versus being still at a loss, I believe, if I had bought it back then. So that's the video. If you're interested, I'll leave a link to it down in the description below. Does this happen the other way around to you often, where a business doesn't quite hit your margin of safety and you miss out on a big gain? Would you ever reconsider your margin of safety, your valuation methods? Thank you. On that last point, not at this stage. I think the valuation process is pretty sound. We're simply coming up with an estimate of cash flows and what we expect to get back from the business. What may change is the way that I estimate what I'm getting back from the business. So I think the structure or the theory of the discounted cash flow of trying to estimate what we get back, that is timeless, because that's all that investing is about, is what are we outlaying for what we're getting back, and what is that relationship? And it's possible that the way that I estimate what I'm getting back is inaccurate, so maybe that changes, but the foundations of the strategy will never change. But does it ever happen the other way around where I miss out on a business? All the time. Absolutely. I just mentioned Visa and MasterCard. I actually haven't looked at their stock prices, but my guess is that they've continued to go up at a ridiculous rate. I think Costco is in a very similar situation, and the same has happened for many, many businesses. But that really doesn't matter to me, because there are a lot of stocks that go up that I don't understand, or that were not at an appropriate price and are rising on speculation. Tesla, I think, is a prime example of that. But there's really no point of thinking that you missed out on something, because as I said, I don't need to invest in those businesses to make a good return. I just need to select a number of businesses, 5 to 10, 5 to 15 businesses over my lifetime, and invest in those that I'm very, very confident will make me money. For businesses I'm not confident that they'll make me money, which are businesses that are overvalued, for example, using your thing as an example, I would not be confident, even if it's a great business. Even if I think Tesla is a really great business, for example, if its stock price is so high that the next 10 to 15 years of growth in their business could result in a flat or a negative stock price, then I cannot be confident in that I'm going to make a significant return. All of the different parts of the analysis process need to line up in order for me to be confident. And when those very few opportunities do come across, I invest in them. And if I can get a few of those right if I pick 15 businesses and I can get 8 of them right or 10 of them right over my lifetime, then that will be plenty in order to make a substantial return in the markets. The next question that we've got here is, what is your favorite valuation method? Moreover, I was wondering, what are your favorite sites for researching stocks? Thanks. Yeah, so my favorite method for valuing a business is a discounted cash flow method, or a net present value, I think is probably the more accurate definition of that. But basically, we're coming up with an estimate of the future cash flows that are left over from the business that can either be used to reinvest in the business and grow it, or can be distributed to us. So the idea behind cash flow for owners, for example, which is the cash figure that we try and calculate, the idea behind that figure is it's all the money left over after the business has basically restored itself to where it was at the start of the year. So in theory, they could use that to pay a dividend, all of it, that would come directly to me, And then the business would be able to just maintain the same cash flows, the same profits in the next year, because they've already taken into account all of the money required to just maintain and keep the business going. So that's the theory behind the discounted cash flow or net present value. And yeah, we're basically just coming up with an estimate of the next 10 years and then beyond cash flows that the business can produce, and comparing that to the price that we're paying for the business. In terms of research sites for stocks, I think probably the best thing that I've used as a shortcut in order to assess businesses is quickfs.net. It's a website that provides you free financial statements for 10 years of data for a lot of US, or all the US businesses, Australian businesses, some European businesses, and some UK businesses as well. And probably some other markets as well, I think. Mexico as well, and Canada. And that site is just fantastic for getting an immediate, quick snapshot at the past 10 years of performance of the business. Because if you go on Yahoo Finance or even something like Morningstar, for example, they'll probably give you maybe 3 years or 4 years of data for free. But that really tells us nothing. The last 3 years of a business has just been pretty much, well, if we exclude COVID, it's just been the strongest period for businesses in an extremely long time. So I would much rather look at 10, 15 years of data to see how the business has trended in all different kinds of market conditions. So QuickFS is probably the number one resource that I use when I'm analyzing businesses. The next question that we have here is the market is very much overvalued. So why is it not falling? Well, markets and individual stocks and other assets can stay irrationally overvalued or irrationally undervalued, or inefficient, in other words, for a very, very long period of time. That's happened across time, different time periods, individual businesses, across markets. It's really no surprise that the markets can be overvalued for a really significant length of time. They can also be undervalued for a very significant length of time. So as an investor, you have to be patient. You need to recognize that markets are not always efficient. And if you buy an undervalued business, sometimes it stays undervalued for a long period of time because the market doesn't realize its value yet. And the same is true on the upside. Sometimes there's a business you want to invest in, or you want to invest in the market, and it's just really, really overvalued, and you have to have the patience to wait for it to revert to the mean, which historically it always does, because businesses need to produce the income that investors expect, and if they don't, the stock prices will fall. That's just the physics, the economics, or the physics of money, as I like to call economics, of how markets function. The next question that we've got here is from Paul. How to learn reading a balance sheet. Is there a good book or a homepage to recommend? Yeah, first of all, I would highly, highly recommend just watching through Khan Academy's accounting lectures that are on YouTube. There are tons of videos on accounting, but also on finance and other concepts around investing. So I would highly recommend those. They are fantastic and timeless, even though they're really old. A lot of those videos are really old, a few years old. They're very, very valuable. I have a video on my channel covering what I'm looking for specifically in a balance sheet. And I don't go through every single line in a balance sheet or how to put a balance sheet together like you would in financial accounting, but I just sort of point out the major things that I'm focused on, such as the debt ratios and looking for equity to be consistently growing over time and things like that. So in terms of the analysis perspective, I'd recommend watching my video. I'll link it down in the description below. But in terms of a broad accounting knowledge on learning the financial statements, income statement, cash flow statement, balance sheet, then Khan Academy is the place you want to go. The next question that we've got here is from Frank. I noticed that you are typically investing in mid-large cap companies. I believe private investors have an advantage in micro small caps, as many institutionals can't access them. Analysts don't cover, and they have bigger runways for growth. All other principles you promote can still be followed. Is this something you consider? Yeah, absolutely. I think that's certainly the case, right? When you have these big institutional investors, they can't invest in really small companies. We see that all the time, particularly if they're a fund that is operating using Warren Buffett style principles where they have a small number of individual businesses. If you have big funds that have thousands of stocks, then they pick up pieces of these smaller businesses. But even in those cases, there are businesses that are just too small for institutionals to hold. So certainly there is a case to be made that there could be more undervalued businesses or more inefficiencies, I should say, in smaller market cap businesses. The only thing to think about is the reason why I tend to gravitate towards medium and large cap businesses is because of that distinct competitive advantage, right? I'm looking for businesses that really have something unique and that have proven it over a really long period of time. And that typically means that they've grown to a significant size. If it's a big industry, it means that they've grown to be a large cap business. If it's a relatively small industry, then it might mean that they've grown to be a medium cap business, but that makes them one of the largest businesses in that industry. But that's certainly not to say that you couldn't find businesses with distinct competitive advantages in really small cap businesses. I just think it may be less common to find a business that has a really long track record of being a great business and that consumers are consistently coming back to, that is valued at a couple $100 million. But certainly it's possible that you could find more inefficiencies in the market in those businesses. And as they grow to become larger and institutional investors recognize them, then some of those inefficiencies may reduce. And then the last question that we have time for here today is, what are some of the biases you've encountered? I feel with my portfolio performance this year, I'm building a strong bias that I am a good stock picker. I don't want that bias to hurt me in the long run. Yeah, that's a really good point. I think that, 2020 was a terrific year, particularly if you bought a lot of stock in March, whether you were buying it based on speculation, just because you thought the market had bottomed out, or whether you had analyzed businesses and they got into buy ranges in March. I think a lot of people did very well in 2020. And I think the important thing is just to, rather than looking at the performance of your portfolio over 1 year as an indication of whether you've done a good job, I think it's a much smarter idea to look at the underlying businesses and whether they're on track to reach the goals that you expect out of them when you analyze them. So when you've analyzed a business, hopefully you had some sort of picture in your head, or you've calculated where you think that business will be. So to give you an example, if it was a retail business, you may have expectations for what their online sales would grow to, how many stores they would build, what the increase or decrease in the sales at each of their stores would be, what their margins would do. So checking the underlying business to see if those things are more or less on track to reach your goal of your expectations in 5 or 10 years. I think that is a much better indication of whether you're doing a good job as an investor, rather than just looking at a 1 year performance. I think the other big bias that a lot of investors face is confirmation bias. It's very easy to seek out information that supports a business that's either in your portfolio or that you want to invest in. And it can be really challenging to seek out opinions that go against your original contention, or to seek out analysis that goes against what you think when you invested in a company. But ultimately, as an investor, I think if you found information that suggested that a business in your portfolio was a bad investment, that might make you feel like you've made the wrong decision. Like, oh, I messed up. I invested in this company, but I shouldn't have. But finding that information is actually the good thing, because ultimately what happens is the truth prevails when it comes to stock market investing. So if you find a piece of information that convinces you that you should be selling a stock, that's a good thing. Right? That's not a bad thing. It's not that you're going back. Don't think of it as if, oh, I made the wrong mistake initially and now I have to fix this mistake. Think of it as you're finding a weed in your portfolio garden and you're pulling it out, right? And that will improve your returns long term. So you should want to seek out the truth, even if it means that you have to sell something in your portfolio. And I think having that mindset is a good way to try and reduce your bias when it comes to stock picking. But there's going to be biases that impact us as investors, regardless of what we do. So you just have to do your best to combat them and seek out information that goes against what you originally think, to try and be as straightforward and as realistic in your analysis as possible. All right, well, that's all the time we had for questions today. And as I mentioned, if you want to ask a question in next month's video, then make sure you're subscribed and have notifications turned on. I'd love to hear your thoughts down in the comment section below, as always, and leave a like if you enjoyed it. But other than that, hope you guys have a great day, and I'll see you in the next video.